When I first encountered Tesla's latest compensation data alongside their sales figures, my initial reaction was to check if I had misread the decimal points. It's not often you see a company respond to declining revenues by increasing executive pay by several billion dollars. But then again, we live in interesting times. Tesla has managed to achieve something that traditional corporate finance textbooks would suggest is impossible. They've created an inverse relationship between operational performance and executive compensation that defies basic economic logic. While their global vehicle deliveries fell by approximately 8.6% in the most recent quarter, their board approved a $29 billion compensation package for Elon Musk. To put this in perspective, that single pay award represents roughly 77% of Tesla's cumulative net income since the company went public. What makes this particularly fascinating from an analytical standpoint is that this isn't aberrant behavior. It's a deliberate strategy. Tesla's board has essentially admitted that they believe their CEO's value to the company increases as its operational metrics deteriorate. This creates what economists might call a reverse moral hazard, where poor performance is rewarded with greater compensation on the theory that the situation would be worse without the executive's continued involvement. The numbers paint a picture that would be comedic if it weren't so consequential. Tesla's market share in Europe has been eroding consistently, with competitors like BYD not just catching up, but surpassing them in key markets. In China, which Tesla had positioned as their growth engine, sales have declined for 9 consecutive months. The company's response to these challenges has been to effectively double down on executive compensation while simultaneously reducing investment in new product development.
From a governance perspective, what we're witnessing is the breakdown of the traditional principal-agent relationship that forms the foundation of modern corporate structure. Shareholders, in theory, hire boards to monitor management on their behalf. Management is then compensated based on their success in generating returns for those shareholders. Tesla has managed to invert this relationship entirely. Their board now appears to work primarily to justify management compensation, regardless of performance outcomes. The company's recent decision to reincorporate in Texas, away from Delaware's more rigorous shareholder protection laws, provides additional insight into their strategic thinking. This wasn't merely a technical legal maneuver, it was a deliberate attempt to insulate management from the type of shareholder oversight that might question extraordinary compensation packages during periods of declining performance. What strikes me as particularly noteworthy is how Tesla's board has chosen to frame this compensation as necessary for retention and focus. This implies that without additional billions in compensation, Musk might direct his attention elsewhere. The logical extension of this argument is that Tesla's business model is fundamentally dependent on one individual's attention span, a rather precarious foundation for a company valued at over $400 billion. The retention argument becomes even more interesting when you consider that Musk's other ventures are already consuming significant resources that might otherwise benefit Tesla. The company's NVIDIA chips have been redirected to xAI, his artificial intelligence startup. Key personnel have moved between his various companies. The boundaries between Tesla, SpaceX, and his other ventures have become increasingly blurred, raising questions about whether shareholders are effectively subsidizing his other interests. Tesla's product strategy offers another lens through which to examine these decisions. The company has essentially abandoned plans for a mass-market vehicle in favor of pursuing autonomous robot access, a technology that remains perpetually next year, despite years of promises. The Cybertruck, which was positioned as a revolutionary product, has become something of an embarrassment, with sales declining precipitously and recalls mounting. This brings us to what I find most intriguing about Tesla's current situation. They've managed to convince markets that declining operational performance justifies higher valuations because it demonstrates the necessity of their management team. It's an elegant piece of circular logic. Poor results prove management is essential, therefore management deserves more compensation, which proves they're valuable, which explains the poor results. The financial structure underlying this compensation deserves examination. Tesla's board has argued that they can assign zero accounting value to this $29 billion package because they believe there's essentially no probability that Musk will actually receive it. This requires believing either that he won't remain with the company for 2 years or that their legal appeal will succeed, both of which seem unlikely given the circumstances. What we're observing here is a fascinating case study in how modern corporate governance can be manipulated when traditional oversight mechanisms break down. Tesla's shareholders have largely accepted the premise that the company's value derives not from its operational performance, but from its association with a particular individual. This creates a self-reinforcing dynamic where declining performance justifies increased compensation, which further entrenches the individual, which makes the company more dependent on them. The broader implications extend beyond Tesla. If this model proves sustainable, it establishes a precedent for other companies facing operational challenges. Rather than addressing fundamental business problems, management teams might instead argue that their retention becomes more valuable as problems mount. It's a novel approach to corporate strategy, though one that seems to benefit executives more than shareholders. Looking at Tesla's competitive position, the challenges are becoming increasingly apparent. Chinese manufacturers aren't just competing on price, they're delivering vehicles with comparable or superior technology at significantly lower costs. European manufacturers have closed the gap in electric vehicle capabilities while maintaining traditional automotive quality standards. Tesla's technological advantages, which once justified premium pricing, have largely evaporated. The company's response has been to pivot toward promising future technologies rather than improving current products. Autonomous driving, humanoid robots, and artificial intelligence dominate their presentations to investors, while actual vehicle improvements receive comparatively little attention. This strategy works as long as investors remain focused on future potential rather than current performance, but it creates obvious vulnerabilities if that focus shifts. Tesla's financial position, while still strong, shows signs of strain that this compensation package doesn't address. The company's free cash flow generation has become increasingly dependent on regulatory credit sales rather than vehicle profits. Their manufacturing efficiency, once a key competitive advantage, has stagnated while competitors have improved theirs. Capital allocation decisions appear increasingly driven by executive preferences rather than shareholder value optimization. The most concerning aspect of this situation may be how normalized it has become. Tesla's board operates with a level of deference to management that would have been considered problematic in previous decades. Shareholders appear to have accepted that traditional performance metrics don't apply to their company. This normalization of exceptional governance structures could have implications that extend far beyond Tesla itself. What I find particularly striking is how this situation illustrates the evolution of modern capitalism toward personality-driven rather than performance-driven value creation. Tesla's market value appears increasingly detached from its operational results and more closely correlated with public perception of its leadership. This represents a fundamental shift in how we think about corporate valuation and governance. The precedent being established here is remarkable. If Tesla can maintain its valuation while delivering declining operational performance and increasing executive compensation, it suggests that traditional metrics of corporate success may be less relevant than previously assumed. This could fundamentally alter how other companies approach the relationship between performance and compensation. Looking ahead, Tesla's situation presents several possible outcomes, none of which align neatly with traditional corporate finance theory. They could continue declining operationally while maintaining high valuations through narrative management. They could begin delivering on their technological promises and retroactively justify current compensation levels. Or they could face a more traditional reckoning where markets eventually demand operational performance regardless of executive charisma. The most likely scenario may be that Tesla continues to operate in this unusual state of suspended traditional corporate logic until external forces, whether competitive, regulatory, or market-driven, force a more conventional approach to governance and performance measurement. What we're witnessing with Tesla isn't just a corporate governance failure or a misalignment of incentives. It's a fundamental experiment in whether modern markets can sustain companies that operate according to entirely different rules than traditional business logic would suggest. The outcome of this experiment will likely influence corporate behavior far beyond the automotive industry.
The financial engineering behind Tesla's compensation structure deserves deeper examination because it reveals how creative accounting can obscure economic reality. When Tesla's board claims this $29 billion package has zero accounting value, they're essentially arguing that probability mathematics doesn't apply to their company. This requires sophisticated mental gymnastics that would impress Olympic judges. Consider the historical precedent this establishes. We've seen companies justify extraordinary compensation during periods of exceptional growth. Think of technology firms during the dot-com boom or financial institutions before 2008. But Tesla has innovated a new approach: extraordinary compensation during periods of declining market share and operational challenges. It's remarkably creative, though perhaps not in ways that benefit shareholders. The competitive dynamics make this situation even more intriguing. While Tesla's board debates billion-dollar compensation packages, Chinese manufacturers like BYD have been systematically dismantling Tesla's cost advantages through superior manufacturing efficiency and supply chain integration. BYD's gross margins on electric vehicles now exceed Tesla's, despite selling vehicles at significantly lower prices. This isn't a temporary pricing strategy. It reflects fundamental operational superiority. The irony becomes acute when you consider that Tesla's original value proposition was technological superiority and manufacturing innovation. Their gigafactory concept was supposed to revolutionize automotive production through scale and automation. Instead, competitors have achieved better cost structures using more conventional approaches, while Tesla has pivoted toward compensating executives for managing decline rather than driving innovation. Tesla's transformation from growth company to compensation optimization vehicle illustrates broader trends in modern finance. When operational excellence becomes difficult, companies increasingly focus on financial engineering and narrative management. Tesla has mastered both, creating a self-reinforcing cycle where disappointing results justify higher compensation, which creates more dependency on individual leadership, which justifies even higher compensation. The psychological aspects of this dynamic are fascinating from a behavioral finance perspective. Tesla's shareholders have essentially entered into a form of financial Stockholm syndrome, where they've begun to identify with management's interests rather than their own. This manifests in their willingness to approve compensation packages that would have been unthinkable under traditional governance frameworks. Looking at Tesla's product pipeline reveals additional concerns about capital allocation priorities. While the company invests billions in robotaxi technology that may never materialize commercially, they've effectively abandoned the mass market vehicle segment where competitors are gaining ground. The Model 2, which was supposed to bring Tesla to mainstream affordability, has been indefinitely postponed in favor of pursuing increasingly speculative technologies. This strategic drift reflects what economists call the Icarus paradox, where past success creates overconfidence that leads to eventual failure. Tesla's early success in premium electric vehicles convinced leadership that they could succeed in any technology sector, leading them to pursue everything from humanoid robots to brain implants, while their core automotive business stagnates. The regulatory environment adds another layer of complexity. Tesla's full self-driving technology faces increasing scrutiny from safety regulators, while their autopilot system has been linked to numerous accidents. The company's response has been to increase promises about future capabilities rather than addressing current limitations, a pattern that mirrors their approach to executive compensation. From a macroeconomic perspective, Tesla's situation reflects broader changes in how markets value companies. Traditional metrics like price-to-earnings ratios, return on invested capital, and market share growth have given way to narrative-based valuation that prioritizes story over substance. Tesla has become the purest expression of this trend, where operational performance is almost irrelevant compared to executive charisma and future promises. The comparison with other technology companies is instructive. Amazon, Microsoft, and Apple have all maintained strong operational performance while providing more modest executive compensation. Their leaders have generally taken salaries of $1 to $2 million annually, relying on equity appreciation tied to actual company performance for wealth creation. Tesla's approach represents a fundamental departure from these norms. International markets provide additional perspective on Tesla's governance choices. European and Asian companies facing similar competitive pressures have generally responded by improving operational efficiency and reducing costs, including executive compensation. Tesla's decision to increase compensation while facing these same pressures suggests either exceptional confidence or exceptional detachment from market realities. The pension fund and institutional investor response to Tesla's governance decisions will likely prove crucial. These large shareholders have fiduciary responsibilities that should make them skeptical of compensation packages that aren't tied to performance improvements. Their continued acceptance of Tesla's approach suggests either sophisticated analysis that isn't apparent to outside observers or a concerning level of passive acceptance. Tesla's situation also raises questions about the role of financial media and analyst coverage in modern markets. Despite obvious red flags in governance and operational performance, analyst recommendations remain predominantly positive. This disconnect between observable problems and professional assessments suggests either superior private information or systematic bias in favor of narrative over numbers. The long-term sustainability of Tesla's model faces several potential pressure points: shareholder lawsuits, regulatory intervention, competitive pressure, and simple financial mathematics all suggest that current trends cannot continue indefinitely. The question becomes whether Tesla can transition back to performance-based governance before these pressures force change externally. Perhaps most significantly, Tesla's experiment tests fundamental assumptions about how modern capitalism should function. If personality-driven valuation proves sustainable, it could fundamentally alter corporate behavior across industries. If it ultimately fails, it may serve as a cautionary tale about the dangers of abandoning traditional governance principles. In the end, Tesla's situation raises profound questions about the nature of value creation in modern capitalism. Are they pioneers of a new model where personality and promise matter more than performance? Or are they simply the latest example of how markets can remain disconnected from fundamentals longer than logic would suggest possible? The answer may determine not just Tesla's future, but the future of corporate governance itself. And that perhaps is the most interesting aspect of this entire strange situation.